Okay, here's a puzzle for you. How does a giant tech company, like a household name, report record revenue, smash expectations on its profitable core stuff, and still watch its stock tank by, what was it, 11% after hours?
Yeah, it sounds completely backward, doesn't it?
Yeah,
But that's exactly what happened this quarter. It was a pretty brutal lesson from Wall Street for one of the biggest players out there.
right.
We're seeing this really profound shift. It's not just about making money anymore. It's about how you're planning to spend it, specifically how fast you're spending it on, the next big thing, the AI infrastructure.
That's the heart of it. This week was huge. We had Apple, Alphabet, and Meta all drop their Q3 earnings. And market's reaction, it wasn't just varied, it was like completely opposite ends of the spectrum for some of them. So we're unpacking what really feels like the quarter that kicked off the great AI CapEx race. It's all about who's spending what and why, and the market is placing massive bets based on those strategies. We're talking hundreds of billions in valuation swings. But hang on, before we really dive deep into that financial drama, we just want to say thanks to you, our listeners. Seriously, the growth, the engagement for the deep dive, it's been incredible.
Really fantastic. And we've heard from a lot of you asking about video, being able to see the charts, the sources we're discussing.
Yeah, exactly. And we're actively looking into that. We found this tool, Mosaic AI video editor. It's really interesting.
Seems like it could be a game changer. The idea is you feed it the audio, like this discussion, and it can help create video summaries, visuals, blog rolls, all that good stuff. Pretty slick.
But tools like that, they require investment. And here's where we need your help, frankly. We can only really access the funds needed for things like Mosaic if we hit a key milestone.
That magic number is 1,000 subscribers.
So, if you're listening now and you find this stuff valuable, please take a second and hit that subscribe button. Share it with people you think would be interested.
Yeah, your subscription literally translates into the resources we need to add video and make the show even better. Help us get there.
Okay, so, mission for today. We're digging into these Q3 2025 earnings.
Yeah.
Apple, Alphabet, Meta. We need to pull out the key numbers, obviously.
Right.
But more importantly, compare their AI spending plans, especially the CapEx guidance, that capital expenditure outlook. That's where the story really diverges.
And figure out what the market actually values right now in this huge race for computational power, for AI supremacy. What's the winning formula according to investors today?
All right, let's frame this up. The source material calls Q3 a bifurcated narrative. I like that term. Basically, two companies looked really solid, financially resilient.
Yeah, Apple and Alphabet, they kind of reinforced their image as these, incredibly powerful, profitable giants. Their results showed the strength of their existing ecosystems.
Apple's services humming along, Alphabet's cloud suddenly becoming a profit machine.
Exactly, justifying their spending. And then you had Meta.
Right. Meta also had, on paper, a fantastic quarter. Revenue growth was off the charts. Core ads business looked great.
Phenomenal numbers, yeah.
But all that good news just got completely wiped out. Why? Because of what they said about future AI spending, the market just read it as way too risky, too open-ended.
That's the punishment.
Yeah.
It wasn't about the quarter they just had. It was about the checks they plan to write next year and the year after.
So the common element here, even with these totally different reactions, is AI. It's clearly become this incredibly capital-intensive thing you just have to do if you want to compete at the top.
We all knew AI was crucial, but this quarter, the price tag really hit home. The fight isn't just about algorithms anymore. It's about who can actually afford to build and run the massive infrastructure needed. Who has the deep pockets?
And that's the great AI CapEx race. What's fascinating is how the market is acting like this instant judge, like making snap decisions. This AI spending, good. That AI spending, bad.
Precisely. They're giving huge props, like a valuation premium, to AI spending that connects directly to near-term results, especially enterprise results.
Like Alphabet selling AI tools to its existing cloud customers and seeing revenue jump right away.
Exactly. That's predictable ROI. Investors love that.
But on the flip side, they're hitting the sell button hard on spending that looks speculative, long-term, without a clear path to making money soon.
So when Meta talks about building capacity for superintelligence, maybe years down the line, the market just sees massive risk. It doesn't matter how good the current ad business is. The tolerance for that kind of long shot bet just evaporated this quarter.
Okay, let's get into the numbers then, side by side. Because you really need to see them together to grasp this weird situation. Three giants, all beating expectations, but their stocks going in wildly different directions.
Let's start top line. Revenue. All three did well,
Yeah.
considering the kind of choppy economy. Apple reported its fiscal Q4, pulled in $102.47 billion. That's up 8% year over year, a record for their September quarter.
Pretty impressive. And Alphabet, they hit a huge milestone.
Yeah, first time ever over $100 billion in a single quarter. $102.35 billion for Q3, up a massive 16% year over year. Just wow, firing on all cylinders there.
Seriously. And Meta, okay, despite the stock reaction later, their growth was actually the strongest percentage-wise.
Right, $51.24 billion in revenue, up 26% year over year. That's huge growth. If you just stop right there, you'd think all three CEOs are popping champagne.
Exactly. But you can't stop there because then we get to the EPS, the earnings per share. And this is where that shocking discrepancy comes in, especially for Meta.
Okay, let's lay it out. Apple. They delivered $1.85 GAAP and adjusted EPS, up 13% adjusted year over year. Solid beat.
Good numbers. Alphabet.
Even better. Stellar, really. EPS of $2.87. That's up 35%. And it beat the consensus forecast by almost 27%. I mean, that just screams financial health, right?
Absolutely. Okay. Now Meta. This is the moment things went sideways. Their reported GAAP EPS, just $1.05.
Fine.
Yeah. Down 83% from the year before. Imagine seeing that flash across your screen as an investor. 83% drop.
Catastrophic looking number.
Yeah.
But, and this is so crucial, that number is incredibly misleading.
How so?
It was entirely due to an accounting thing, a one-time non-cash income tax charge, something like $15.93 billion related to new U.S. tax laws. It had nothing to do with how the actual business performed day to day.
Okay, wait. So you strip out that one-time tax hit. What did they really earn operationally?
Their adjusted EPS was $7.25.
$7.25 compared to the reported $1.05.
Yep, a massive difference. And that $7.25 number, it actually beat analyst expectations pretty handily. So operationally, the core business was doing great.
Okay, my head's spinning a bit. If adjusted EPS $7.25 beats expectations, core business strong. So why the 11% stock plunge? Why didn't the market see past the accounting noise?
Because the future spending plans immediately overshadowed the past performance. That $7.25 reflected Q3 results. But the forward guidance, especially about CapEx for 2025 and even hinting at 2026, that dictated future risk. So Alphabet's strong quarter plus confidence in their spending plan sent their stock up 8%. Apple's solid quarter and steady plan up 4%.
But Meta's strong quarter got completely negated by fears about future spending.
Exactly. The projected cost of their AI ambitions, regardless of current profits, signaled way too much uncertainty for investors right now, down 11%. Strategy trumped results.
Okay, let's focus on Alphabet then. The market darling this quarter. Hitting $100 billion revenue is huge, but it feels like more than that. It feels like they really proved their whole AI strategy.
I think that's right. They showed they could weave AI into their existing monster profit engines rather than having to invent totally new businesses. Google Services, Search, YouTube, etc. brought in $87 billion in revenue, $33.5 billion in operating income. Just incredible scale. That funds everything.
And what about that big fear? The one people worried about for ages? That generative AI would kill the search ad business.
Yeah, the cannibalization fear. If AI gives you the answer directly, why click ads, right?
Right.
Well, Q3 numbers pretty much blew that fear out of the water.
Right.
Google search revenue was up 14.5% to $56.57 billion.
So it grew despite AI.
Grew strongly. And Pichai, the CEO, said explicitly that the AI features, like overviews in AI mode, are actually helping. They're driving more searches overall, including the ones with commercial intent, because the AI is making search more useful.
Huh. So AI is actually boosting the core business.
Seems like it based on these numbers. It's enhancing the money-making machine, not breaking it.
But the real star of the show, the reason the market loved the spending plan, has to be Google Cloud. Right?
Oh, absolutely. That's the core justification.
Yeah.
Cloud revenue jumped, was it 33.6% year over year? To $15.16 billion. Impressive growth.
But it's not just growth anymore, is it?
No, and that's the critical part. Profitability. Cloud's operating income almost doubled to $3.59 billion, up 84%. That proves they're not just giving away AI services, they're selling high-value, high-margin compute and AI capabilities that businesses are willing to pay serious money for.
And they quantified the AI link directly, didn't they?
Yeah, management said 70% of cloud customers are now using their AI products, and the revenue specifically from generative AI models grew more than 200% year over year.
200%. That's explosive demand.
It really is. And that demand translates into future certainty. Their backlog, like the signed contracts for future work, it soared to $155 billion.
Wow, $155 billion in committed future revenue.
Exactly. This isn't theoretical maybe money. It's locked-in deals from enterprises needing the data centers and compute power that Alphabet is building.
Okay, so that's why the CapEx number didn't spook investors. They raised the forecast for 2025 to $93 billion, almost $100 billion in spending. Why wasn't that seen as reckless?
Because it's directly tied to that $155 billion backlog. It's not speculative spending, it's necessary investment to meet confirmed demand.
Gotcha.
That $93 billion goes into data centers, GPUs, cooling systems, land, all the stuff needed to fulfill those contracts. The market sees a clear loop. Demand justifies CapEx. CapEx builds capacity. Capacity generates profit. It feels much safer, much lower risk than just building stuff and hoping customers show up later.
Right. Which brings us back to Meta. They had the amazing core quarter, but got hammered 11%. Let's acknowledge just how strong that core business is first, though.
Absolutely. The family of apps, Facebook, Instagram, WhatsApp, it's just a cash cow. $50.77 billion in revenue, and get this, $25 billion in operating income in one quarter.
$25 billion from just that division.
It's staggering. And like Alphabet, they credit AI for a lot of that success. Their recommendation engines, the ad targeting systems, they're incredibly effective. Drove 14% more ad impressions and let them charge 10% more per ad. That's efficiency.
So the core is humming. But the problem child is still Reality Labs, the metaverse division.
Still the big drag.
Yeah.
Yeah, revenue grew, which is good, up 74% to $470 million. Maybe some traction with new hardware. But the cost, another $4.43 billion operating loss this quarter alone.
$4.4 billion. And what's the running total on losses for RL now since 2020?
It's now over $70 billion.
70
billion.
cumulative operating losses.
The mind-boggling scale of investment in that vision. You need very, very patient investors for that.
Which leads right into the forward guidance problem. They raised 2025 CapEx, okay, to $72 billion, a bit less than Alphabet's number, but the reaction was the polar opposite.
And it wasn't just the 2025 number, was it? It was the language around 2026.
Exactly. That's what set off the alarm bells. Management warned that 2026 CapEx growth in dollar terms would be notably larger than 2025, and overall expenses would grow at a significantly faster percentage rate.
Notably larger, significantly faster. That sounds like the spending is accelerating, potentially uncontrollably.
That's how the market read it. Open-ended, no clear ceiling, and focused on building capacity for, well, what exactly? And when will it pay off? This really highlights the strategic difference, doesn't it? Meta doesn't have a Google Cloud equivalent, right? No big, profitable enterprise arm to easily sell AI services into.
Exactly. Alphabet is selling picks and shovels to the existing gold miners. The enterprise is already spending billions on cloud. Meta is trying to create a whole new gold rush, either in the metaverse or with new consumer AI gadgets.
So Meta has to spend big on infrastructure first for things like new AR glasses or AI assistants, and then hope those products catch on and eventually generate revenue.
That's the bet. It's inherently riskier, more speculative, and probably takes a lot longer than selling AI tools to businesses that already need them.
So the market saw Meta's guidance not as strategic investment like Alphabet's, but as this huge open-ended bet on superintelligence or some future tech years away without a clear bridge to get there.
Pretty much a massive front-loading of capacity for something undefined. Investors are basically saying, show us the path to monetization before you spend another $70 billion plus. That risk aversion is why the stock dropped 11%, even with great current revenue.
Okay, let's shift gears to Apple. They seem to be taking a completely different path in this whole AI spending race, more about strengthening their existing fortress.
Yeah, definitely playing their own game. They had a record fiscal Q4, $102.47 billion revenue. iPhone's still a bedrock, right? September quarter record, $49 billion, up over 6%. That phone just keeps churning out cash.
But the real story lately, the stabilizing force, is services, isn't it?
Oh, absolutely. The services flywheel. We talk about it a lot, but it's critical. It surged 15% to an all-time record of $28.75 billion in revenue.
Why is that segment so important for stabilizing Apple?
Because they have this massive installed base, like 2 billion devices out there. All those users are potential customers for high-margin recurring services. App Store cuts, Apple Music, iCloud storage, Apple Care.
Right, locked-in customers paying month after month.
Exactly. It's predictable, high-margin revenue that smooths out the ups and downs of hardware sales cycles. That $28 billion plus a quarter is pure profit fuel.
Okay, but it wasn't all smooth sailing. There was that weakness in China.
Yeah, that was the one significant headwind. Greater China revenue dropped 3.6%, down to $14.5 billion. Missed expectations there.
What's driving that? Just the economy there, or is competition heating up?
Probably a mix of both. The macro environment in China has been challenging, plus you have really strong local competitors like Huawei making a comeback. If Apple's user base starts to shrink or stagnate in a huge market like China, that could eventually slow down the services engine too. That's the key risk to watch.
So how does Apple approach AI differently then? We're not hearing about them spending $90 billion on data centers.
No, they're deliberately avoiding that infrastructure arms race. Their strategy is much more about integration and, frankly, cost avoidance on that massive scale.
How do they monetize AI then?
They call it Apple Intelligence. The plan seems to be embedding advanced AI, probably a lot of on-device processing for privacy, directly into their premium hardware, enhancing Siri, making the iPhone, Mac, iPad experience smarter, more personalized, more useful.
So the AI isn't the product itself, it's the reason to buy the next expensive iPhone or Mac.
Exactly. Use AI features to drive the hardware upgrade cycle. You buy the new device, you get the cool AI stuff, and you stay locked into their ecosystem, paying for those high-margin services.
Clever. Leverage their strengths. User experience, hardware, software integration, supply chain, without getting into the raw compute spending war.
Precisely. Sell the elegant experience, not the underlying infrastructure. Maximize margins, minimize the giant speculative capex risk that Meta and Alphabet are taking on.
And it seems to give them confidence. Tim Cook sounded pretty bullish about the holiday quarter.
Yeah, he projected 10% to 12% revenue growth for the December quarter, called it potentially the best ever for the company and the best ever for iPhone. That's strong optimism, a real counterpoint to the spending anxieties elsewhere.
Okay, so let's try to pull this all together. Comparing these three giants, what are the big strategic takeaways from this quarter?
Well, first, you just have to acknowledge the power of the core businesses. That massive profitability, $25 billion quarterly operating income from Meta's apps, $33.5 billion for Google services, that's the entry ticket. That's what lets them even consider these multi-billion-dollar AI bets. It creates a huge moat.
Right, you need that engine, but the key lesson seems to be how you justify spending that money.
Exactly. The divergent capex justification. Let's nail that down again. Alphabet. $93 billion for 2025, justified by accelerating cloud revenue and that huge $155 billion backlog. Spending driven by current demand.
Okay, and Meta?
$72 billion for 2025, potentially notably larger in 2026. It feels speculative. Building capacity for future tech shifts like the metaverse or superintelligence, plus funding the ongoing Reality Labs losses. The ROI timeline is fuzzy.
And that directly shapes how the market values them right now.
Totally. There's a clear premium for AI spending that feeds existing successful businesses. Alphabet gets rewarded. There's a big discount for open-ended speculative spending with no clear payoff date. Meta gets punished. Predictability is king right now.
Investors want proof before the big checks are written, not just promises.
Seems like it. They value the established monetization channels heavily.
So, looking ahead, what should we be watching? Key indicators for each company.
Okay. For Apple, keep an eye on that services growth rate that's crucial, and watch the Greater China performance closely. Any recovery there? Or does the pressure continue?
Got it. Alphabet.
All about Google Cloud. Revenue momentum, can they keep that 30% plus growth? Operating margin, does it keep improving? And that $155 billion backlog, does it keep growing? That validates the whole CapEx story.
Makes sense. And for Meta?
All eyes are on the actual spending. What do the CapEx numbers look like next quarter and the quarter after? Do they stick to that notably larger guidance? And critically, any signs of real monetization from AI within Facebook or Instagram, something tangible. Plus, can those Reality Labs losses start shrinking, even a little?
Right. Need some proof points there.
That's
So wrapping this up, it really feels like we've hit this major turning point, doesn't it? Where financial success isn't just about profit today, but about how smart, how credible your spending plan is for tomorrow's tech.
Absolutely. The next year or so feels pivotal. We'll see if Meta's huge gamble spending massively now to potentially leapfrog everyone later with superintelligence or a working metaverse actually pays off. Or does Alphabet's more grounded, enterprise-first approach build an unbeatable lead in AI?
It sets up a really interesting strategic choice. We know that core business profits are funding all this. So here's a thought for you to chew on. If you were running one of these companies or investing in them, which strategy would you back? The one offering pretty clear near-term ROI by selling AI into existing successful businesses.
Like Alphabet's Cloud Play.
Right, or the strategy that risks enormous sums on a potential revolutionary leap years down the road, betting big on superintelligence or a whole new platform.
Like Meta's Reality Labs and future AI push.
It's that classic dilemma. Maximize current certainty or swing for the fences on a future paradigm shift. No easy answer there.
Definitely something to think about. And hey, as we finish up, just one more reminder about how much we appreciate you listening and supporting the show. We're genuinely excited about adding video.
We really are. So please, if you haven't yet, hit subscribe. Share this episode. Remember, hitting that 1,000 subscriber mark is what unlocks the funds we need for tools like the Mosaic AI video editor.
Yeah, Mosaic looks like it could really streamline things. We
Yeah.
feed it the link, it helps generate visuals, summaries, makes the whole video process much easier for us.
We're eager to do it, but we really do rely on your support to get the resources. Help us reach 1,000.
Thanks again for tuning in.
Until the next deep dive, thanks for learning with us.
We'll catch you next time.